Somewhere on a high street near you, there's a pharmacy for sale. On paper, it looks like a dream small business, guaranteed footfall, a product every customer eventually needs, and a government contract that pays you every single month. Here's the catch. Last year, more than 650 UK pharmacies closed for good, the highest number in 20 years. Since 2015, the network has shrunk by over 1,400 branches, and yet every year people still buy pharmacies, still open new ones, still bet real money on this business. So which is it? A safe, recession-proof asset, or a business quietly collapsing under its own weight? By the end of this video, you'll know exactly what it costs to own one, where the profit is actually supposed to come from, and why so many owners are ending up upside down on a business that should, in theory, never run out of customers. There are two ways in: build one from scratch or buy an existing pharmacy. Building from scratch sounds cheaper on paper. The regulatory fees themselves are almost trivial. Roughly £1,500 covers your NHS pharmaceutical list application and GPHC premises registration. But that number is a trap if you stop reading there. Once you add fit out, dispensing equipment, pharmacy management software, security systems for controlled drugs, and your opening stock, the real total investment typically runs from £50,000 for a very small setup to £400,000 or more for a full high street unit, with most realistic first-time budgets landing somewhere between £150,000 and £250,000. And that's before you've served a single customer. NHS contract approval alone can take 4 months. GPHC premises registration another 3. So you're often looking at 7 to 12 months of rent, staff and licensing costs before any revenue arrives. Buying an existing pharmacy skips that waiting period. You inherit a working NHS contract, an existing patient base and immediate cash flow. That's why most people choosing between the two options end up buying rather than building. But it comes with its own baggage. Under TUPE regulations, you're legally required to take on existing staff and their existing contracts, whether or not they fit how you want to run the business. And valuations vary sharply. A pharmacy contracted for standard hours is worth noticeably more than a 100-hour pharmacy, which typically sells for only 50 to 80% as much, because those extended obligatory hours eat into profitability. So you've bought the pharmacy. Where does the profit actually come from? Roughly 90 to 95% of a typical pharmacy's income comes from NHS, dispensing. Not the shampoo, not the greeting cards. For every NHS prescription item dispensed, the pharmacy claims back the cost of the drug plus a flat dispensing fee, currently £1.52 per item under the single activity fee, on top of a separate medicines margin allowance. Industry consultants use a rule of thumb here. A pharmacy typically needs somewhere around 3,300 to 3,500 regular patients just to break even. Beyond that point, a well-run pharmacy can expect net profit, after all costs, before tax, of somewhere between 7% and 13% of turnover. That's the theory. In practice, that margin has been getting squeezed from every direction at once. Community pharmacy funding has absorbed a real terms cut of around 30% since 2015, while staffing, rent and energy costs have kept climbing. The National Pharmacy Association estimated the sector was facing over £275 million in additional costs this year alone, driven largely by rising minimum wage and inflation. Here's what most new owners don't fully appreciate until they're already trading. You don't set your own prices, and you don't even get paid what you actually spent. When you dispense a generic medicine, you're not reimbursed for what you paid your wholesaler. You're reimbursed at a nationally set drug tariff price under a mechanism called Category M. The assumption baked into that system is that pharmacies collectively can buy stock below the listed price and keep the difference as margin. Periodically, the government recalculates that assumed discount and adjusts the reimbursement price down, effectively clawing back money it assumes you're already making, whether or not your own pharmacy actually secured that discount. Then there's the opposite problem. When a drug's real wholesale price spikes due to shortages, you can apply for a temporary price concession. But that correction lands weeks or months after you've already dispensed the medicine, potentially at a loss, out of your own working capital. The result, an owner can dispense a prescription today and not actually know whether that transaction made or lost money until well after the fact. This is why every guide to opening a pharmacy tells you to hold 3 to 6 months of operating costs in reserve before you even open the door. Because in this business, cash flow risk isn't a possibility, it's a built-in feature of how you get paid. Put the ownership costs and the reimbursement mechanism together, and the failure pattern becomes obvious. An owner who spent £200,000 getting a pharmacy open, or who took out finance to buy an existing one, is now running a business where 90% plus of revenue comes from a fee that's been cut in real terms for a decade, reimbursed through a formula that can retroactively reduce what they're owed. Surveys of the sector have found a striking share of owners are now saying they don't know how much longer they can continue trading, with many reporting they've had to remortgage their own homes or dip into personal savings just to keep the pharmacy's doors open. This isn't a story of bad business decisions. It's largely a structural mismatch between what it costs to run the shop and what the national contract pays for the work done inside it. And the closures aren't random. They cluster hardest in the areas with the least room to absorb it. Deprived towns and cities where the pharmacy was often the only accessible healthcare access point on the street, and where an owner has the least ability to supplement NHS income with private, higher margin services. There has been a genuine policy shift, though the scale of it is still disputed. For 2026/27, the government agreed a 10.3% funding uplift, taking total community pharmacy funding to £3.64 billion, alongside a boost to the medicines margin allowance and a small rise in the per item dispensing fee. Alongside that, the expansion of Pharmacy First, letting independently prescribing pharmacists manage a wider range of conditions from autumn 2026, is a real attempt to give owners a second income stream that isn't purely tied to how many boxes get handed over the counter. But the sector's own negotiators accepted this deal while explicitly stating it does not mean we think it is enough. Independent estimates still put the underlying funding gap at somewhere between £2 billion and £2.5 billion a year across the sector, and some modelling suggests the uplift will be largely absorbed by rising costs before an owner ever sees the benefit. For someone weighing up whether to buy a pharmacy today, that's the real question to underwrite. Are you buying into a sector on the way to being fixed, or into the same funding pressure with a slightly longer runway? Scenario 1. Building a new pharmacy from scratch in a mid-sized town, total investment around £200,000, including a 7 to 12 month wait for NHS contract and GPHC approval before opening, during which rent, staff recruitment and licensing costs are still running. Once trading, you need roughly 3,300 plus regular patients to break even, with realistic net margins of 7 to 13% of turnover in a good year, before accounting for loan repayments on the original investment. Scenario 2, buying an established standard hours pharmacy with an existing NHS contract. Immediate cash flow and an inherited patient base remove the waiting period, but you take on existing staff under TUPE, inherit whatever goodwill or reputation issues came with the previous owner, and still face the same Category M and price concession mechanisms that can leave you short for weeks after dispensing a medicine. The purchase price itself reflects the pharmacy's contracted hours. A standard hours pharmacy commands a real premium over a 100-hour pharmacy precisely because those extended hours often destroy more margin than they generate. Either route, the fundamentals are the same: a business built around something every person eventually needs, running on a margin that isn't set by the owner, isn't guaranteed by demand, and can move against you months after the sale is already made. Whether pharmacy ownership is a stable asset or a slow-moving risk depends entirely on which side of that funding settlement you end up on.